Welcome to our economic snapshot from May 2026, focusing on the latest trends in the U.S. housing market and inflation. The economic climate in May 2026 is marked by high mortgage rates and rising housing costs, creating significant hurdles for prospective buyers. We are seeing high 30-year fixed mortgage rates, coupled with high home prices, sidelining many borrowers from purchasing new homes. Key factors contributing to this challenge include high mortgage rates, soaring home prices, and increasing costs like insurance and property taxes. Understanding what drives these mortgage rates is crucial for grasping the current market dynamics. Mortgage rates closely follow Treasury yields, which have recently seen an increase.
Treasury yields rose in April due to inflation hitting its highest rate in 3 years, pushing inflation rate up to 3.8%.
This significant rise in inflation rates is largely linked to the surge in gas prices since the start of the war with Iran. Despite the challenges, some buyers are still actively engaging with the housing market, albeit with caution. It's worth noting that mortgage rates are still lower than they were a year ago, which some savvy buyers are utilizing. Buyers are taking their time, being highly selective, and demanding more concessions from sellers, especially if the home requires repairs. Let's turn our attention to the latest figures on inflation and wage growth from April 2026. Americans saw their inflation-adjusted average hourly earnings decrease by 0.3% in April from the previous year. This marks the first time since April 2023 that inflation has outpaced the annual wage growth rate. High-income households, benefiting from the stock market boom, are significantly driving up prices and services due to high demand. Increased housing costs are also causing a significant jump in foreclosure filings across the country. Foreclosure filings have reached a 6-year high in Q1 of 2026, primarily due to increased ownership costs. Q1 foreclosure filings jumped by 26% from a year earlier, totaling 119,000 units, indicating widespread financial strain. Let's break down exactly how much the average property tax and home insurance have increased over the past year. The average property tax for a U.S. single-family home rose 3% to $4,427 from last year. In the same period, the average home insurance cost increased by 12% to $2,948, adding significant burden to homeowners.
Other financial pressures, such as rising homeowner association dues and increasing delinquencies in credit card and auto loan debt, also contribute to the rise in foreclosures.